whenever you have these very negative biases on an asset class, when there's blood in the street, as Baron de Rothschild once said, that's when you want to start looking at this stuff. It's painful. It's terrible to try to own this stuff. It's no fun to try to own it. But look, you don't get buying opportunities when everybody's piling onto an asset, right? If everybody's buying it, there's no opportunity to make money with it, right? You may make money over a month or two, but you're not going to make long-term real money with it. You got to buy stuff when nobody wants it.
So is this the blood in the streets moment for bonds?
Oh, yeah, it's been that way.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good and stalwart friend, portfolio manager Lance Roberts. Lance, welcome, buddy. It's a Friday the 13th.
Yeah, exactly. So lots of stuff to talk about today.
Lots of stuff to talk about today. Actually, an awful lot to talk about because since the last time you were on last week, we've had some very tragic but very concerning global geopolitical developments. I'm very interested to see how those might affect the markets. They certainly, for whatever reason, didn't serve as a drag on them this week. Market is up for the week, about 100 S&P points so far. But I'm curious, what impact, either short and or long term, are you expecting from the recent developments in the Middle East?
Well, it's interesting that you said that because I'm actually writing about that in this weekend's newsletter.
I'm shocked. I'm shocked you're writing an article about something I talked about.
I tell you, yeah, exactly. So, yeah, at realinvestmentadvice.com, our newsletter this weekend is actually, I actually drew a very long-term chart of the S&P 500 going back to 1900 and listed all of the war events that have gone on, conflicts, wars, interventions, etc. And while sometimes you get a kind of a knee-jerk sell-off in the markets, like, oh my gosh, this is going to be really tragic. Wars are actually good for markets. The reason is they create economic growth. You've got to produce arms and supplies and all kinds of stuff for the war effort, either for your own troops or for supplying, weapons or support for other countries. That generates economic activity. So markets are pretty quick to factor in kind of the more bullish impact on markets and earnings, but you can't dismiss the human tragedy. That's the important thing. But from a market perspective, they tend to be very kind of knee-jerk events initially, and then markets tend to start to rally off of them after that.
Okay. Yeah, obviously we don't know how this is going to end up yet. And I hate to sort of put it this way, if you're an economy that is supplying war material to what's going on, but you're not actually engaged in it yourself on your own soil, maybe it probably is stimulative in a cruel way to think about it. Middle East powder keg area, in this particular conflict in Israelis versus Arabs, I'm not a geopolitical analyst, but you have a lot of the world's largest powers that have a side, largely in that conflict, meaning they could be drawn into this if this thing continues to worsen, right? And there's all sorts of concerns that Israel may retaliate against Iran, who it thinks funded the Hamas attack, and now Israel's engaged with Hezbollah up in the north as well. So this has potential to spiral, and hopefully it doesn't. But if it does, oil prices go up.
Stop. This is the argument that always comes out every time there's a conflict in the Middle East. And not saying, look, Nostradamus once said that, one of his predictions was that World War III would start out in the Middle East. But don't forget, we were in Desert Storm in 1990. We invaded Afghanistan. We invaded Iraq. We've been involved in wars with terrorists for the last 40 years. And every time that we get involved, or every time something happens, whether it's Russia bombing in Syria or whatever it is, everybody immediately jumps to conclusions like, oh my gosh, this is going to be the start of World War III. It hasn't yet. And again, but this is the same narrative that comes out every single time there's conflict in the Middle East. And, you simply have to realize that at the end of the day, while everybody's got a hot button for a nuclear war, nobody really wants that. Not even Iran wants a nuclear war, because the consequences of that, look, Israel's armed to the teeth with nukes. Iran's got nukes, even though they won't admit it. And so a nuclear war in the Middle East is not good for them or for anybody. Nobody wants it. That's why they call nuclear deterrence. But we've had this same narrative for 40 years, and this always continues. Immediately, as soon as something happens, everybody jumps to this kind of situation. Israel and the Palestinians have been at conflict with each other since 1965. And it's this is something that continues to happen over and over again with them. And will this time, will Israel push all the way to the coast this time and finally end this issue with Gaza and the Palestinians? I don't know. That's not my job. But and again, I've gotten so many emails this week. Oh, this is the beginning of World War III. I need gold and bunkers. The markets are going to look past this very quickly.
Okay. So I totally hope you're right. Fortunately, history has been on your side so far that none of the prior escalations here have gone all the way to 11, on the threat level.
Yeah. Not saying
and that's sort of where I was going with the question, which is, okay, hopefully not World War III, because that's a nuclear, like that's a whole other ball of wax.
Yeah.
But let's say it metastasizes to the point where folks think Lindsey Graham has a good idea, and we start blowing up Iranian oil refineries in retaliation for what's happening on the ground with Hamas or whatnot. That would obviously destabilize the oil markets. I mean, I guess my point is there a risk
Sure.
premium here that if this continues to metastasize will creep into markets here and have some sort of notable impact? And if so, how would you expect that to manifest? Or you just I don't know, we just have to take it day by day?
You do. You just take it day by day. I mean, we can, the problem with coming up with all of these kind of, again, what we're talking about here are third and fourth standard deviation events, right?
Mm-hmm.
So sure, anything can happen, right? And when it does, then you'll have to make some adjustments at that time when it occurs. But this is the whole problem that we've had with the inflation fight over the last year, and all these things is that people said, well, if you got inflation, I don't want to be in risk assets, but that's been exactly the place to be. Everybody's like, well, if you have inflation, you want to be in gold. That's been the worst place to be. So it's not. None of this stuff plays out as if everybody, as the way everybody expects this, because that's how markets work. When everybody thinks one thing is going to happen, the markets always do something different. And so that's why you got to always just take this for what it is, rather than making these one-sided bets of, oh, I need to be in a bunker now because this is going to definitely manifest itself into World War III. If it does, none of this is going to matter. The stock market's not going to matter. Whether you're in a bunker or not, it's not going to matter. None of this is going to matter. So, let's just pray for the best that cooler heads eventually prevail. This is kind of one of the normal conflicts that we've seen between the Israelis and the Palestinians over the last 30, 40, 50 years. And it resolves itself, and they go back to their separate corners, and then we move on for a while, and this will happen again. But making these big one-sided bets typically never work out for the better.
Okay, and just to my question there about oil and its impacts, interestingly, looking at oil, oil prices it rose in response to this, but it's not even back at the highs where it was like 2 weeks ago, right? So obviously, the oil market's not that worried at this point.
Well, again, you had a massive overvaluation of oil. Just a couple of months ago, oil prices had a very big run. They were extremely overbought. We were talking about that. You and I were talking about very extremely overbought oil. We sold down our positions in oil stocks a couple of months ago in anticipation of that correction. We've had a very nice correction, and yesterday we added to our oil positions again because now they're oversold. And or not yesterday, day before yesterday. But now that the oil prices are very oversold, so you just needed a headline of some sort to create some commodities buying in that. So again, traders are buying some oil futures right now, and that's driving up the price of oil on anticipation that this could be something else, and this could cramp supplies. But again, Israel and the Palestinians are not that big of producers of oil on the relative map. So the only way this really starts to take hold is if OPEC says, guess what, we're not going to ship any oil at all now because of we don't like what's going on. they're not producing more oil. They're keeping their cuts in place for right now. So that is going to weigh on supply. Obviously, we have the issue with the SPR here in the United States. That's got to be refilled at some point. So that's going to crimp on supplies. So there's certainly some catalysts that can keep oil prices elevated, but the market's already kind of factoring all that stuff in.
Okay. And so speaking of the market, do me a favor if you can, pull up your S&P chart that we try to pull up every week here. Back to your point. So, one of the reasons why we're kicking things off here with what's going on over in the Middle East is, I think, an understandable question that the armchair investor has had is, oh my gosh, is this like a sell the market kind of news event? Certainly hasn't been so far. I think you're saying, no, it probably isn't. We've been talking a lot about how the market was approaching strongly oversold levels on a technical basis. And you've got the chart up here right now. Yeah. We can see the bounce that it took, 2 weeks or so back, a few weeks back. We told people, look, if you've got a really big bearish thesis right now, just know that from a technical standpoint, the market looks like it's poised for a bounce. It actually did bounce. It's now coming back down, as you're putting that line in there, to some sort of support. And so I'm going to hand you the torch, but the question here is sort of, is this a sort of sell the news market? Should we all get real defensive? I'm going to guess your answer is not until we see some more confirmation.
Well, a couple of things. First of all, is that we came down the 200-day moving average, as we talked about, and last week, we wrote in the newsletter, hey, market's sitting on 200 days moving average support. We expect a strong rally next week as we head into earnings season. That'll trigger a MACD buy signal, and that all occurred. And so we had this very sharp rally earlier in the week, ran right into resistance at which is those two moving averages where they're basically touching. That's the 50 and the 100-day moving average. So the first test at resistance failed, and we're now sitting on the 20-day moving average, that orange line, which is support. And this is very normal for an initial reflexive rally off an oversold condition. Importantly, though, we did trigger the MACD buy signal. So that triggers our seasonally strong period for the markets. Just started earnings today, had Citigroup, JP Morgan, others reporting bank earnings today. Those came in better than expected. And also they had less loan loss reserves this time, suggesting that charge-offs aren't as much of a concern as they were. So that's important. But get a pullback into support, work off some of the real short-term that overbought move we've got, and then potentially you get another an attempt to break above those moving averages, which, if that's going to occur, will happen next week or the week after. We'll get that push higher as we get further into earnings season, and then of course once we get through the end of the month, we're going to hit buyback season, which will begin November the 1st.
Okay, so there's a lot of, potential tailwinds for this market coming ahead, right? You said, the seasonally strong time of the year for markets, and it's for the economy too, right? I mean, we have obviously the holidays coming up. You have mentioned on the past couple of videos that Halloween is a surprisingly big commerce day for the economy. So, lots of consumer spending about to go on. And the buyback window opening back up, that's obviously going to be more than likely than not supportive for stocks. So, I'm glad that we've started this practice of bringing this chart up again and again, week after week, Lance, because, there have been periods along here where understandably, the emotion either on the fear or the greed side, has kicked in, and you as an experienced capital manager, are urging caution. So back in July, you were saying, look, we're really overbought here, folks. I know everyone, the markets are now partying like it's never going to end, but we're probably going to have a 3 to 10% pullback. That's pretty much exactly what we've gotten here. And then as things were looking kind of darker and everybody was freaking out about the bear steepening in yields and how high yields were going on the long end of the curve just a couple of weeks ago, you said, guys, look, I can jump on that macro train of all the concerns you have, but from a technical standpoint and otherwise, the history of markets suggests we're oversold and this is likely going to bounce. That has been what has happened. Now, you don't have a crystal ball. You're not right all the time. Right. But what you want to be is that Warren Buffett quote. You want to be, I'm not getting it exactly right, but he's sort of like, you want to be approximately right rather than being precisely wrong.
Yeah.
Right.
Well, and again, we could come back down here and retest the 200-day moving average. That still doesn't change, where we are. And so, what happens over the next 3-4 trading sessions? You can have more of a sell-off here, absolutely. And, and then you get set up. And again, this market's going to just kind of work its way as we kind of go through this cycle. And again, the strongest period of the October through May strong period is actually November, December, January. So the stronger months actually occur in November and December. Get that year-end rally, the Santa Claus rally we always talk about. Then, of course, everybody comes back from the holidays and they want to position for the new year. So November, December to January tends to be really strong months. February tends to be a little bit weaker month. And then you get March, April, May. So, you've got, from a seasonal perspective and just, kind of just traditional markets, you've got 3 of the strongest months coming up once we get through October. So again, expect a little bit more sloppy trading for the next couple of weeks. So, depends on how earnings season goes. Earnings are going to be good. We've lowered earnings from $224 a share to $180. So you got a 20% decline in EPS estimates for this quarter. So you're getting an 80% beat rate, millennial earnings season, right? Everybody gets a trophy. And, what'll be important there is about forward guidance. So we hear a lot of stuff about, oh my gosh, we're about to have layoffs and, the outlook is terrible. If that's the case, then, we could see a very different market begin to shape up. So what really happens over the next couple of weeks in earnings is going to drive markets more than anything.
Okay. Just a quick plug for our upcoming conference in a week. Super excited to hear from Michael Kantrowitz with his HOPE framework. A huge part of that story is going to be what's going on in the employment sector. And we'll be diving deep into the employment data with Michael. As a reminder, the E in the HOPE framework is employment. And obviously, earnings drive how much companies can afford to employ people. And that's actually the O in, that's the P in Michael's HOPE framework for profits, corporate profits. So we're going to get a really detailed update on both of those in Michael's presentation there. All right, so real quick back to this chart, Lance, and then we're going to move on to another topic related to it, which is, there's that poem, that famous poem, If, by Rudyard Kipling.
Yep.
Which starts, if you can keep your head when all about you are losing theirs and blaming it on you. I'm going to come back to this poem later on at the end of our discussion today. But that really is your job, right? As a client capital steward, right? It's your job to keep a clear, steady head, no matter what's going on, to let the emotions of both the market and individual investors, your clients' emotions, you're kind of supposed to be the bulwark, against them, to say, hey, yep, I know things are emotional right now, but we just got to try to remain level-headed and prudent and just look at the data. I think you've done a really good job of that this year for the reasons I talked about. And, you take a lot of abuse for that, right? So back just a couple of weeks ago, when it looked like we were, coming down to test the 200-day moving average, there are a lot of people who I know were emailing you and saying, Lance, you don't get it. This is it. This is the beginning of the end, right? And you had to just keep your head and, be the steady hand on the tiller. And lo and behold, the price action has proved out to be what it is. So I want to commend you for that. I do want to trundle in a second to a topic that people are still blaming you for today, which is bond yields and the impact that's having on bond prices. Real quickly, before we go there, can we just make a detour through inflation? Because we got the new inflation data out this week, which, on a surface level, maybe people might take as kind of good news, because, the inflation rate basically stayed the same on a year-over-year basis, 3.7%. It actually was hotter on a month-over-month basis. It came in at 0.4% on a month-to-month growth rate in September. So, maybe a little bit hotter than the Fed wants to see right now. But I'm curious, what's your takeaway of the importance of this the CPI print, if any?
No, it was absolutely a non-issue, and the Fed's going to look right through this because this is still the majority of what we saw in the inflation report. And this is a chart of CPI on a monthly annual percentage change basis. What we saw in the report was essentially just the lag effect. Remember, so when CPI is calculated, it's using energy prices from 3 months ago. It's also using housing prices from 3 months ago. So when you take a look at rentals and what was going on with homeowners equivalent rent and oil prices 3 months ago, those were escalating higher. So the print you're seeing right now is going to cool off sharply over the course of the next couple of months, and particularly as we get further into the winter. So, but if we just look out at, and again, this is such a critically important thing. And you and I touched on this last week, and again, everybody forgets this. The Federal Reserve does not want deflation. They don't want zero inflation. They don't want negative inflation. So the price of gasoline, the price of used cars, the price of houses, they don't want those to go down. They're still going to be higher next year than they are now. They want them to be 2% higher a year from now than they are today. That is not deflation. So if you're expecting housing prices to go down, gas prices to go down, food prices to go down, you're not understanding what the Fed wants. The Fed wants inflation. They want 2% inflation, which means gasoline is not $4 a gallon, it's $4.08 a gallon next year. Mm-hmm. That's what they want. And so this whole idea that, oh my gosh, we're not getting, 2% inflation right now and prices are still too high. Yeah, they're too high from the way we're used to having them, but they're not going down anytime soon until we get into a recession. Then those prices are going to drop pretty quickly. But that's, a different story, and that's a different topic. That has nothing to do with the inflation print. So no, inflation's running. You look at PPI, you look at CPI, you look at import-export prices. They're trending lower. And again, and if we just kind of run a projection out over the next 12 months, we're going to be pushing somewhere around 2.6% by this time next year, just assuming normal run rates.
Okay, and obviously for folks looking at this chart, the dotted red line at the far right end of the chart is sort of RAA's prediction of the likeliest trajectory of where the CPI rate is going to head from here, correct?
Yeah, well, this is something we started about 6 months ago. So the latest print is this little uptick right here that you see on this. That we have this downtrend and this little pop up. That's the latest print, and so it's just basically following almost exactly to a T what we laid out almost a year ago.
Okay, great. So the script is playing out as you have expected it to.
Yeah.
Okay, so now let's trundle on over to bonds. So bond yields have cooled off a little bit, and then of course, and they came down a little bit after the weekend with the geopolitical events in the Middle East. But they've kind of ping ponged around a little bit this week. I love on the one of the comments there on that Twitter feed that you just closed, where the guy said, "Lance, dude, was just watching your show. What the heck happened in bonds yesterday?" Right. So yeah. I know you're getting bombarded with this. Real quick, I just want to get your thoughts on the latest U.S. 30-year Treasury auction, which apparently was one of the poorest showings for an auction that we've had, in a while. And at least there's a lot of kind of headlines going on about that, which is like, all of a sudden, the Fed's trying to jawbone the dollar down. Janet Yellen's over in China. Folks feel like she's just asking, hey, please buy our bonds. So, there's sort of this narrative coming out right now that all of a sudden the folks at the top are beginning to get nervous about this bear steepening in yields. Any feedback on that latest auction and its level of importance?
Yeah, I was actually just looking over at Zero Hedge. They had a chart about this yesterday. This falls into the realm of Dumb and Dumber for a lot of these comments that you just made. For the most part, if I can find this chart,
I'm sorry. Were mine the dumb comments or the dumber comments?
No, you're relaying the general premise of the market, and I can't find this one chart I was looking for. Anyway, if you take a look at auctions, they look like a rubber band. They're up and down, up and down, up and down. And so when you have a poor auction one week, you have a really great auction the next week. And so it just depends on what's going on in the market at any particular given time. And it has absolutely no relevance to what's going on. But let's talk about this whole idea, this thesis you just brought up, is that Janet Yellen's overseas begging people to buy our bonds. That is a complete load of crap. The reason is that, people have been coming out lately going, oh, China doesn't want our bonds and Japan doesn't want our bonds. Okay, so first of all, China owns $800 billion worth of our bonds. We have 33 trillion in debt. That's about 2.5% of our total debt load is owned by China. If they dumped all of our bonds, it would make no difference because they don't own enough of our bonds to matter. The Federal Reserve owns 8% of our bonds, right? They own $8 trillion worth. So they own a very big chunk of our bonds. So if the Fed starts dumping bonds, that's going to be a different issue. Japan owns a very small amount of our bonds as well. So they have no real big impact, but they're not. And yes, they've reduced their holdings some. That has nothing to do with not wanting our bonds or anything else. It's about balancing currency and balancing trade. And we talked about this before. China sells 50 billion, pick a number, $50 billion a year in stuff to the United States. If they took $50 billion worth of purchases that we make from China and then pulled it all back into their currency would be astronomically stronger than what relative to the US dollar. That makes things on a trade basis unequal and not advantageous to China at that point. So China has a choice. When the dollar is too strong or the dollar is too weak, they can opt to sanitize trade. And they do that by storing those reserves created from transactions in US Treasuries. And this is why people store reserve currency in US Treasuries and as a function of balancing trade and keeping some level of stability in currencies so they don't get too far out of whack. Yes.
And that's a great point. I just want to explain for users here what you're saying, because it's really important, which is because they don't want to absorb the dollars that we're giving them for all the stuff that we buy from China into their economy and therefore cause their currency to shoot the moon. They've got a challenge, which is, well, what do I do with these dollars, right, that I don't want to absorb? Well, I got to put them somewhere. Well, what's the biggest, safest market out there to store dollars in? It's US Treasuries, right? So that's why so many countries park their money in US Treasuries. It's also when this whole concept of, something's going to replace the dollar as the world's reserve currency. One of the big challenges to a contender is you have to have a really big, deep, safe market to park stuff in, right? And most other currencies just don't have that. So I just mentioned this so that when people, see all the very, all the reasons why we could very validly get concerned over the long-term health of the US dollar, you have to answer that question. And without a really good alternative, the dollar is probably not going to get toppled from its reserve currency status anytime soon.
And it's not Bitcoin. So now moving on, let me finish this up real quick because there's more to this. So first of all, in our daily, so we run a daily market commentary on our website every day, and we publish this out 7:30 sharp every morning. So if you subscribe to it, you're going to get this by email every morning. But the last 2 days, we've been covering this topic in particular. And the first one was, what is going on here? Stop. Okay. So again, this chart is incredibly important. So there's a couple of things on this chart that you need to know. So here's a couple of context about what's going on with the headlines, right? People don't want, nobody wants our debt right now because we've got too much debt, 33 trillion. We've had a deficit for almost 40 years and it just became a problem last week. I mean, we've been running deficits since 1980. So now all of a sudden deficits are a big problem. Our debt to GDP ratio, we're at 114% of debt to GDP. That's a problem now. When it wasn't a problem at 100% of debt to GDP, it took us to get to 100. It wasn't a problem at 111, and now it's a problem at 114. Japan is 250% of debt to GDP, and they're doing just fine. Why? Because Japan, the central bank of Japan, owns 80% of the bond market. I'm not saying that's a good thing. I'm just saying that this whole notion that interest rates are going to go to the moon because nobody wants to buy the debt is a very false narrative, because ultimately at the end of the day, the Federal Reserve will buy the debt. In fact, Janet Yellen just recently saying lower for longer. Michael Leibowitz just wrote an article about this on our website, acknowledging the fact that we have to have low interest rates in order to sustain the growth of our debt, which is directly tied to the growth of our economy. But what these charts show, a couple of things that really kind of bust that narrative in general. So first of all, the upper right-hand quadrant is our total federal debt on a log scale. We're running below trend in terms of our debt issuance right now. based on our long-term trend of debt issuance. The bottom chart is our debt to GDP, which has been declining now really ever since the pandemic. So in other words, our economy is actually growing faster than our dead issuance. So that's actually a good thing. We want that to be the case. And so this other idea that nobody wants to own our debt, everybody, all foreign governments are selling our debt, et cetera. Not really the case. This is federal debt held by foreign investors, and the upward trend line, yeah, it moves up and down over time. And again, we've had a very strong dollar lately, so that doesn't surprise us that we're seeing a little bit of reserve sell-off here. That's not a big issue, but again, the trend of debt ownership is continuing to rise. So there's this whole narrative of other people not wanting our debt and all this. It's just not true. Again, to the very point you made, which is absolutely correct, you've got to have a currency where you've got a rule of law, you've got a very deep liquid market, you've got stability in the rules of how things operate, and you can count on the function of that debt being any debt that you have being made good on. And name another country that you can go to and have all those kind of variables put in place where you'd be willing to store your currency. Is it the Chinese yuan, the Brazilian, the Brazilian dollar? What is it? There's just not, Iran, Iraq. I mean, pick a country. There's just not a lot of good choices out there where you've got that kind of stability and depth of market to store your reserves. And so these narratives just don't hold any water and are not the issue of what's driving the market. If you want to know what's driving the market, it's the fact that we have one of the largest short positions against bonds on ever. And that alone has been one of the key drivers for higher interest rates. There's momentum trade going on right now. You've got everybody piling onto this momentum trade of shorting bonds. That's driving yields up. And as you saw earlier this week, as soon as there's any type of, retracement in that narrative of wanting to be short bonds, you have very, very big moves in yields very quickly. And that's that short covering process. So when you get into a trend of lower rates, that short covering is going to accelerate that downtrend when it occurs.
Okay. And look, there's an article you wrote this week we're going to get to in a second called "Bond Valuations Are Cheap."
Yeah.
But you just made a statement that might be news to a lot of viewers, and it might be maybe a missing piece for a lot of them, where you just said the bond market is being shorted to an extent that we've rarely seen before.
Right.
Elaborate.
Well,
why? Who's doing it?
the same people that short commodity futures or short oil prices. How did we have negative oil prices in 2021? How could that happen, right? Did supply stop the demand for oil stop altogether? No, it's all driven by the commodity and the options markets and on NYMEX where we trade futures. And so right now you've got a huge chunk of what they call computerized trading algorithms and these kind of hedge fund driven portfolios that manage billions upon billions upon billions of dollars. They are, there's a trend, there's a negative trend in the momentum of the bond market. So they're piling on to that trend. So whenever there's a trend in one direction, they tend to exacerbate that trend, whether it's negative oil prices or rising yields. They're shorting bonds on a consistent basis to ride that momentum. And they're going to keep riding that momentum until that momentum changes direction. And when it does, then they're going to flip to being buyers. And so every time yields move, they're going to be buying more and more bonds, which are going to drive yields back towards zero. So this is how we get into these crisis related events in the markets, which is, and more so over the last, 10, 15 years in particular, because this is really the advent of computerized algorithms and all this other stuff that's going on. These kind of momentum bets that are being done is what's creating this bigger volatility in markets and why you see stocks fall 90%. Why you see these exacerbated moves in commodity markets that don't really make sense relative to the fundamentals, but it is what it is because you've got huge groups of people with lots of money and control driving these prices in one direction or the other.
Okay, so when you use your analogy there about oversold and overbought, right, as the elastic band that's getting further and further stretched, Do you see the bond market at a point right now where bond prices have been oversold to the point where how stretched is that rubber band under these current conditions?
It's on a longer term basis. It's rarely been this overdone.
Okay.
So, that doesn't mean it's going to, and this is why, we talked about before, when I'm buying bonds in my portfolio personally, I keep telling you it's 18 to 36 months. It's 18 to 36 months. It's a longer term time frame, but you have very rarely seen in history where you have the bond market 4 standard deviations above long-term monthly moving averages. That just doesn't happen.
Okay. So would you put this on a comparable basis with what you just mentioned with oil back during the pandemic when it got to negative prices briefly for a moment? That was a very oversold moment for oil.
Yeah.
Are we sort of at a similar level of oversoldness here?
Yeah. I mean, this is equivalent to negative oil prices. This is equivalent to stocks in 2009, March of 2009. And it's always interesting. Psychology is exactly the same, right? March of 2009, I couldn't have got you to buy stocks to save my life, but that was the time to buy stocks, right? So, this, and now it's the same thing. Nobody wants to own bonds. Everybody's coming up with all these theses why nobody wants to own bonds. That tells you it's probably about the time to start buying bonds. Just because all of these thesis and analysis and all this stuff, it'll change. And when something occurs, some type of recession, crisis event, whatever it is, and again, there's no telling when that'll be. Timing is always the issue. But when you get the reversal of that momentum in the markets, it'll reverse strongly.
Okay. So maybe we can go to your article and you can pull up any charts from that you want to in answering this question. But one of the reasons why I'm putting my finger so directly on this is I think what I hear you saying is, look, in my career as a portfolio manager, as a steward of client capital, I'm seeing one of those rare moments in time where, you don't always get a bright light shined on something that says this thing is really underpriced right now from a historic basis. It sounds like you were saying to me that that's happening with bonds. Would you say that this is one of the best time to buy bonds, if not the best time to buy bonds that you've seen in your career as a portfolio manager?
Well, that's why I'm buying bonds personally. And
so that's a yes.
Yeah. So, I mean, I'm just telling you what I'm doing, and you can take from that what you will. I'll tell you this: on February 14th, 2008, I wrote an article at that time and published it called 8 Reasons for a Bull Market. And of course, on February 14th of 2009, the market's down 20% from the peak in January. Not to mention the previous, 30, 40% down from the previous year. And of course, at that point, everybody's like, are you crazy? This market's going to zero. Who wants to own stocks here? It was the end of the world as we knew it. And then, of course, March the 9th was the bottom, of the market. So again, you very rarely get these opportunities where the world is so convinced that something is dead. Give you a couple of good examples. You and I were on this show, right? In 2020, November 2021, I said right here on the show with you that, going into 2022 is going to be a great opportunity to own energy stocks because everybody hated them. ESG was dead and oil was dead and nobody wanted it because of ESG. And I was like, you very rarely get this type of opportunity to own energy stocks. And then on November the 4th of 2022, just last year, wrote an article, Are FANG Stocks Dead? Everybody hated FANG stocks. And those have been the best performer this year. So again, whenever you have these very negative biases on an asset class, when there's blood in the street, as Baron de Rothschild once said, that's when you want to start looking at stuff. It's painful. It's terrible to try to own this stuff. It's no fun to try to own it. But look, you don't get buying opportunities when everybody's piling onto an asset, right? If everybody's buying it, there's no opportunity to make money with it, right? You may make money over a month or two, but you're not going to make long-term real money with it. You got to buy stuff when nobody wants it.
So is this the blood in the streets moment for bonds?
Oh, yeah. It's been that way. It's been that way for a year. You've never had 3 negative years. Since 1787, you've never had 3 negative years in a row for bonds. And this will be the 3rd year if it happens. Okay.
I was going there with this question. How likely do you think it is that we have a 4th year underperformance in bonds?
Anything is possible.
Anything's possible. I know that. Anything
is possible. I'd highly suggest that it's not going to be the case.
Yeah. Okay, yeah,
I mean,
and just as
it didn't even happen in the 70s. You never even had 3 years in a row during the 70s inflation spike. You didn't have 3 years in a row of negative bond returns. So
right, right. And I've asked this of you, and I think a couple people recently, but I just wanted to do it again, given your very good diatribe here.
yeah,
The fact that we are having a third year this year is historically unprecedented, right? Never happened, since they started keeping records in the late 1700s, right? Now we're at a point where, the odds of a fourth, it's sort of like flipping a coin, right? The further and further you go out getting all the same, the probability, yes, on any individual flip, it's a 50-50 probability, but the probability of it happening in series gets incredibly less the further you go along. So, all right. So Lance, thanks for helping me shine this bright light on here for viewers, which is, you're basically waving a flag now saying, folks, we have a historically attractive moment in time here. You've shared that you're, putting your money where your mouth is, not just on the accounts you're managing for your clients, but that personally you're being even more aggressive in this asset class going forward.
you think I'm being aggressive? You can ask Mike Leibowitz when he speaks at your conference, but he's buying call options on bonds, so he's even more aggressive than I am. Because he's putting a timestamp on his. I'm not. I can wait 36 months. His call options expire.
Thank you for reminding folks that. And folks, yes, Michael will be speaking at our conference in a week. He will also not just be giving a presentation, but he's making himself available for live Q&A. So if you have specific questions about the bond market, show up at the conference and ask him them directly. All right, Lance, anything else to say about bonds before we move on from that? I mean, I guess one question is sort of like the rubber band analogy. Is it the kind of thing that when it starts reversing, it's highly likely to reverse pretty quickly because you're going to have the whole short covering aspect to it?
Yeah. This is one of those things like, go, well, there's like a lot of people that are going, well, I'm just in cash right now and I'll buy bonds when they start to improve. The problem with that is by the time that you recognize the improvement, you'll have already missed 40% of the move. So, you'll miss the biggest chunk of the move because it's going to happen very, very quickly when it occurs. And particularly if the Fed starts cutting rates, it'll happen very fast.
Okay. So the point being is this is one of those things that to capture, a material chunk of the appreciation, you're going to have to be in the position when that happens, right? And so, well, we're going to get to your trades in just a moment, but I assume you'd think that this is a time for people, especially if you haven't been in the bond trade yet, to start dollar cost averaging in, right? Where you're using, the current low prices as a good, entry point. And yeah, it might take another 12 to 36 months, like you said, right? So don't necessarily expect it to go to the moon tomorrow, but you're increasing your exposure. And then as time goes on, you're getting closer to that turnaround date whenever it finally manifests.
Yeah. And again, it's just, you said, I'm shining a light on this. It's like, no, I've been talking about this for the last 6 months, right? So
I know you've been talking about. I just want to make sure the audience is really perking up their ears.
This isn't like today I just woke up and did this. No, this is this conversation that we've been having for months now. Is that the undervaluation in bonds relative to stocks makes them extremely attractive versus stocks, and particularly. Rising interest rates are not great for stock valuations. So when the Fed starts cutting rates and interest rates start to fall, valuations are going to be falling along with them because earnings will be declining. So there's that rotational shift from equities into fixed income is also going to be a big driver of that gain in price.
All right, and I'm going to ask you to just speculate here. In terms of the level of overvaluation, kind of like what are you playing for? And maybe we'll say this with your personal holdings, so it's not necessarily not holding you to something that your clients might hold you to, but right. 10-year right now in the high 4 percentiles. Like, what are you kind of playing for? Like a 2% handle on the 10-year, 3%?
No. If you have a recession, you'll be 1% ish. Don't forget, we got to 0.3 on the 10-year in 2020.
Okay, so what rough math in your head? What kind of percentage price appreciation would you expect to have in bond yields under those type of scenarios?
You should get anywhere from 30 to 50%.
Okay. So basically you're setting yourself up for a 30 to 50% gain in price while getting paid in the high 4 percentiles, along the way.
Yeah.
Yeah. I mean, and you've got the safety of the U.S. government, is the backer of the principal of those bonds. So from a risk return standpoint, yeah, I mean, that's pretty freaking hard to beat right now.
Yeah. And again, it's going to be different. If you run out and buy a, 10-year bond today at par value and then yields fall tomorrow, that bond's going to go up in price. But your greater appreciation is going to come from buying deeply discounted bonds that were issued at much lower coupons. Because remember, it's always price and yield are the same thing. So, people go, well, what should I, there's a bond out here that's currently got a coupon of 3.5, or I can buy this 4.5% coupon. It's the same thing. It doesn't matter which one you buy. They're both going to yield 4.5 because yields are always the same. It's the price that varies. So my greater appreciation is I can find, a 10-year bond that's issued that has a much lower coupon. I'm going to have a big depression in price. So when that bond matures at par value, I'm going to have a bigger price appreciation on that return to par.
All right, that's really interesting. I'm glad you brought that up, and I hope folks are realizing this, where most people who are not super experienced bond investors would just look at the coupons.
Yeah.
Right?
I get this.
Say, higher coupon better, but you're really saying look at the yields.
Yeah, because the yield is what matters at the end of the day. The coupon doesn't matter. It's always the yield to maturity. So because government bonds always going to mature at face value. So government's always debt. So just in theory, right? If I could find a 10-year treasury that was trading at 50 cents, you're not going to do this, by the way. I need easy math. But if I found a 10-year treasury that was trading at 50 cents on the dollar, and I buy it at 50 cents on the dollar, it's going to mature at 100 cents on the dollar. The government, when it matures, it's going to yield 100 cents on the dollar. So I'm going to get that appreciation. But this is why yield is what matters. If I look at that bond, it's going to have exactly the same yield as a new issue coupon bond, because the yields are always the same. Why? If Adam has a bond with a 3% coupon, and I have a bond and I'm issuing a bond at 5%, why would anybody want to buy Adam's bond, right? It's a 3% coupon. So the only way to make that bond attractive to a buyer is he's got to discount the price so that ultimately when that bond matures at face value plus that 3% coupon, it's exactly the same yield as my 5% coupon today. So never buy a bond for the coupon. It's always about yield to maturity.
Okay. So basically bond market hyper efficient, right? So it's doing the real-time pricing for you as everybody bids for this stuff, right? Whatever the coupon is, it's getting the yields to equilibrate. Again, just in case folks didn't get it, why do you expect the bond that sells at a lower price because it has a lower coupon to appreciate more than, say, a brand new bond issued today if the future plays out the way you think it's going to?
Well, we're talking about percentages. Right. So we're talking about percentage gain.
Percentage gain, exactly.
Right. Yeah. So if I have a bond, so what's a bigger percentage move? So let's say I have a bond that I issue out at 100 cents on the dollar, and when yields fall, it's going to trade at a premium. Now it's going to go from 100 to 110, right? Because as the price moves up, the yield comes down again. It's always matching yield to the market.
Yep.
So if I can find a bond that's trading at 80 cents on the dollar, and I'm just throwing out math, right? But it goes 100 because now everybody wants that bond as prices are falling. It's going to gain 20%. So there's going to be some potential arbitrage in the market. And look, the bond market's going to flesh out arbitrage really fast. And this is why, we were talking about a minute ago, you've got to be positioned before this happens, because any arbitrages that exist in the bond market are going to go away immediately, because everybody's going to figure this out very fast. But again, this is why, if you're buying, and none of this matters if you're buying TLT or you're buying EDV, whatever. this conversation has nothing to do with you because it's the price is going to move with the appreciation in bond prices. But there are bonds out there in the markets that are marked much lower than probably where they should be, and so there's some potential arbitrage there that, if you're able to find the bonds and able to acquire them, you're going to make a better return potentially than buying a new issue coupon. My point of the conversation is that I'm getting a lot of emails saying, I want to sell my old bond that has a 4% coupon to buy this new one that has a 4 5/8 coupon. It doesn't matter. The yield is exactly the same. So all you're doing is selling one bond at a loss to buy another bond with the higher coupon. And it's fine if that makes you feel better, but it's all about yield at the end of the day. And just selling a bond that's down in price is not going to matter, because at the end of the day, when everything goes to equal, the yield is going to be exactly the same. Okay. Price appreciation and coupon versus just coupon.
Okay, got it. So I guess I'll just sort of summarize as a takeaway for folks listening here is great time to buy bonds. There's real opportunity within bonds to create better gains than just buying the latest bond that's being sold at the most recent auction. But it's a little mathy. You need to have experience doing it. If you just want to ride the general trend, use the ETFs. You just mentioned, the names of a couple of them, like TLT. But if you want to explore something a little bit more sophisticated than that, and you don't have a ton of experience trading bonds yourself, which from the feedback I'm getting from folks, the vast majority of people, work under the partnership and guidance of a experienced professional financial advisor who, understands these instruments and can give you advice on that.
And look, just real quick, we kind of went all around the circle there, but there's a lot of moving when you're building a bond portfolio. And look, I'm not a bond expert. That's not my bailiwick. That's Mike's bailiwick. That's what he does for us. But this is what Mike and I are doing all the time, is that we're looking for situations that are unfairly priced relative to where they should be in the market, whether it's mortgage-backed securities or closed-end funds trading below par value. There's a lot of opportunities where things get mispriced, and you can take advantage of that. But those mispricings won't last long, because the market will figure that out when things start to move, and then they'll price them fairly. So that's my point of the conversation, which is, again, going back, don't get caught up in the coupon. That has nothing to do with anything. It's only yield that matters. And ultimately, what we're playing for here is for the Fed to cut rates, have a recession, yields come down, prices go up. That's your opportunity. Okay,
awesome. All right, moving on from bonds, and great discussion there, Lance. Thanks for going deep with us on that. I kind of had to chuckle a little bit today, reading some of the latest headlines about FTX. Right, this is Sam Bankman-Fried's crypto exchange. It kind of fell out of the headlines for a long time. I was interested in watching the 60 Minutes the other week, where they interviewed Michael Lewis, right? Probably the greatest financial, what do you want to call him? Storyteller, forensic journalist. He's written just iconic books about some of the greatest successes of Wall Street. And as fate would have it, he was embedded with Sam Bankman-Fried all through this whole process. So he was writing a book about the whole, FTX sort of miracle, and then was there watching it once the news came out and the whole thing started to fall apart, right? So you've got probably the best man for the job, there with a front row seat during the whole thing. And what's kind of interesting is, he's basically saying, like, he doesn't think that he said, I don't think Sam Bankman-Fried truly really believes he did anything wrong, in this story. It wasn't like a mustache twirling guy who was trying to defraud investors and run a true Ponzi scheme. But what's interesting is what's coming out now is one of Sam Bankman-Fried's top lieutenants, his former girlfriend, Caroline Ellison, who ran Alameda Research, which was basically the entity that they're going to get in a lot of trouble for. She's basically admitting, she's kind of turned state's evidence and said, oh my God, I was being forced to write create balance sheets to reflect that we were doing things, we were much better off than we were. And, Sam was siphoning off client funds to do things he shouldn't have been doing. So it actually does look like real criminal activity was going on. And it just sort of shows that, like, it's just more of the same, right? Like this is it's truly these stories that are too good to be true. They generally always end up playing out the same. That, yep, it was overhyped, and it was unsustainable, oftentimes ill-gotten criminal activity at the core of it. And FTX at this point seems like it probably was no different.
Well, and again, we've seen this going, all the way back to Mount Go. Money disappears. We saw, with Binance and a lot of others. So, it's, this whole, look, I get it, right? Cryptocurrency, it's a cool thing. We're all going to move to a digital currency at some point. That's just a function of time. We're there now. I mean, for the most part, I can't remember the last time I actually pulled cash out of my wallet. So, we're all definitely headed in that direction. But as I've said before, it's going to require ultimately a lot of regulation. And it's not going to be this kind of free-for-all Wild West thing that, there's complete anonymity and all that, because no government is going to allow that to occur, because the flow of currency is very important, not only to economic stability, but also to national security. Got to know where the money's going, on funding terrorist organizations or whatever. So, there's eventually going to be a cryptocurrency. The government's going to highly regulate it. Every government's going to regulate their own currency at some point. Will definitely be there. What the ultimate future for Bitcoin is and Ethereum, I own some, as just full disclosure. I don't know. I've owned the currencies for 3-4 years now. I started out as an experiment and just to learn more about them, and again, just I still hold them now, just kind of watching the ebbs and the flows. But I don't really see what the future is going to be. There's not to date really any viable use for these things, other than potential one-off transactions where I can maybe buy something with Bitcoin. But Tesla tried it. They abandoned that very quickly because of the volatility. I can't have if I'm going to have a currency, I can't have a currency that's moving 10 or 20% a day. That's just not viable for business. It's got to be stable. That's the one beautiful thing about the dollar. Yeah, it may be fiat, but it's stable, right? I can make a transaction. I can pretty much count on the value of whatever that dollar is that I'm receiving for my goods or services that I'm providing. So eventually, someday, this is going to have to be more organized and more stable. And whether it's a central bank digital currency or whatever it is, it will be regulated. These issuances will be regulated. And again, it doesn't mean there won't be other coins that are issued, but they are going to fall deeply within the Securities and Exchange rules and regulations for issuing securities. And because that's the way they will ultimately be treated is, oh, great, you want to issue a coin? That's awesome. It's a security. It's just like going IPO with a company stock. So you have to meet all the requirements. And again, that's to help eliminate fraud and people losing millions and millions of dollars, which is always terrible when it happens. But I do find it interesting. It's always, at the end of the day, Adam, the woman scorned. She is definitely having her day in court.
Oh man, Lance, you're going to get us in trouble with both the crypto fans and the ladies watching this channel.
Well, look, I'm not trying to offend crypto fans. Again, I own them, right? I'm just saying, from my personal perspective, I have not seen a valid use yet for the cryptocurrency that I own. And remember when cryptocurrency was first gaining, this was supposed to take the place of all real estate transactions. Crypto was going to take the banks out of the middle. We're going to do, peer-to-peer transactions and all this stuff real time. It's yet to occur. Not saying that it won't, right? It just hasn't yet. And, it's been over a decade now. So we'll see. We'll see. Again, I'm not poo-pooing cryptocurrency at all. Again, I own some, but I think we've got a lot further to go than what a lot of people think before we get to some end use of whatever cryptocurrency is going to eventually become.
Yeah, and it's kind of interesting. Bitcoin has been hanging in at the sort of 20,000 range for a good while right now. I mean, its volatility really has kind of gone down, and have just been interested. Is it stabilizing, and is that sort of a show of strength, and it may power higher from here because for whatever reasons, or is this just sort of the coyote is still just hanging out in midair, and gravity's taking a while to kick in. Who knows? And I don't want to make this a cryptocurrency video just because I'm totally not prepared to have that discussion right now.
Well, and that's not my expertise. That's
no,
not
and it's not either. But where I'm going with this is actually I've seen an increase. I always get a couple a week, but I've seen an increase over, I'd say, the past month of viewers saying, "Hey, Adam, bring somebody from crypto on, from crypto, or at least Bitcoin on." Let's hear the latest sort of fair argument for why it's got a big future ahead of it. Folks, if that would be of enough interest to enough of you, let me know in the comment section below. And if there is enough, I will. Your wish will be my command. I'll go out. I'll try to find one of the most prominent Bitcoin or crypto specialists. We'll try to keep it as agnostic as possible, and hear what they have to say. All right, so. The only bow I want to put on this part of the conversation is that no matter how potentially perfect the underlying asset that you are working with, fraud is a human story as old as time, and it looks like this time was no different. The miracle that was happening at FTX that nobody could fully explain, but everybody wanted to be on board. At the end of the day, does look like it had its roots in just pure old fraud.
Well, and just remember, you can't have fraud without greed. And at the end of the day, this is all about greed. And maybe his simple jack argument will prevail in court. We'll see. It certainly doesn't look that way right now. But I'm not sure I was too stupid to know better is going to play.
Right. But, especially after Caroline, I guess, mentioned the words Thai prostitutes. Whenever that comes up, in the deposition, it's not good. And apparently what she was talking about is they look like they paid a lot of client funds as basically a bribe to foreign nationals, which highly likely was players in the Chinese government and potentially a group made up of what might have been sort of, I don't know how Chinese prostitutes came in the mix, whether it was a ring that ran a bunch of Chinese prostitutes. I don't know if there's the Thai prostitutes themselves, but it's just not looking good. We'll put it that way.
No. But again, like I said, at the end of the day, it's all about greed. And look, you're never going to extract greed from the financial markets, and you're never going to extract greed when you have, an ability to just issue something without any real rules or regulations. And, this is always the issue that we talk about when you're thinking about doing any type of private investment, any type of unregulated investment of any sort. You've got to do multiple levels of your due diligence, because this is how people get scammed all the time, from a variety of deals. But crypto was super easy because there's not anything really out there to stop or to formulate the creation, right? It's not a cryptocurrency doesn't have a gold backing to it. Doesn't have an asset behind it in a lot of cases. It's just somebody's idea and some code. And that's very easy to replicate when you have so much demand for it and everybody's wanting to go out and get, whatever the latest one was. It was very easy to create a fraudulent environment for that and sell something that may have had no value and no real intent at all. And we saw it, and it wasn't just FTX. Again, we saw several of these where money just evaporated and people went on the lam and nobody ever heard from them again. So, but that's why you've always got to be really careful when you're making investments. And one of the reasons that, buying things that are highly regulated, like stocks, like bonds, like commodities, which are highly regulated, those, at least, there's oversight over those assets, which helps and doesn't solve it. Obviously, you had Alan Stanford and Bernie Madoff. It doesn't keep you from having fraud. It doesn't keep you from being defrauded, but it certainly helps minimize the risk somewhat, because you own that asset in your account. It's held in your name, at Fidelity, at Schwab. You can see it on your statement. There's a value attached to it every day. that really reduces the risk of you winding up in some type of fraudulent transaction and losing all your life savings.
Right. Well, and also the financial reporting that's required by regulations, which is total nightmare if you run a public company, but it's there for a reason, right? And you got to be very careful in the private markets. We've talked a little bit about this in the past, Lance, not a lot, but a little. And just again, here in the FTX example, Caroline Ellison was saying that Sam Bankman-Fried demanded that she create 7 different versions of the balance sheet so that he could pick the one that he wanted to show investors, right? Can't really do that with a public company. It's not that they can't still monkey stuff around, but their ability to do so is much less limited than like, hey, let's just make up some numbers and show a piece of paper to our investors, and that's all we're going to give them for the year, right?
Yeah, absolutely.
Yeah.
Absolutely.
All right, so we're beginning to get tight on time, so I'm going to start winding down. I want to put up one chart here, if I can, just to note, we talk a lot about where the economy is going and the fact that we have a big consumer-driven economy. So goes the consumer, so goes the economy, at least in theory. We are seeing consumer spending really beginning to look quite weak. So this is the percent change in consumer spending. I think it's percent year-over-year change, if I'm not mistaken. I don't think it's monthly. But basically, you can see 2023 really starting in October of last year. So it's basically been a year of negative growth. And we have now, in the past month, we've exceeded the worst monthly growth or worst monthly negative growth month that we experienced during COVID, which was April of 2020. So to me, Lance, I mean, this catches my attention. This is definitely like a strong blinking light on the dashboard of the economy. I'm curious to get your reaction to this.
No, it's what you would expect. If you look at 2021, you had 34%, 22%, 16%, 10%. So not surprising that as the money's been running out and now that you're restarting student loan payments, that you're starting to get a reversal of that spending. And again, but you're reversing that spending from very, very high levels, and we're working our way back towards a normal trend of spending. So it's important to extract the number that you're looking at. It's like, oh my gosh, we're down 10%. Yeah, it's a big number, but don't forget that we were up 9.8% in 2021 and another 1%, 22% for the same month in September. So, yeah, we're reversing and 13% in 2020. So yeah, we're reversing some of that spending that we had previously, as savings run out, as the student loan payments restart. And that's going to help. That's going to do 2 things. It's going to slow the economic growth, and it's going to pull inflation down.
Right. And just to use your analogy on this, the direction is important, right? Like, let's say your change in altitude is 1,000 feet, right? That's important, but it's much less of an issue if you're starting from 30,000 feet and going down 1,000 feet. It's a much bigger deal that if you started at 900 feet and then you've gone down 1,000 feet, that's where you have impact, right? So it really matters where you are in the story. But, when we're looking at trends, when we're looking at direction and momentum, this is showing that the consumer is weakening.
Yes. And it's exactly as you should expect. And that underlines that narrative of potentially, softer profit growth, softer earnings as we go into next year.
Okay. As we wrap things up here, I just want to go back to that. We're going to get to your trades in just a second, Lance. Well, actually, why don't we get to your trades now? We'll get to your trades now, and then I'm going to do a little personal opining. So, what trades have you guys made over the past week?
We only did 2 things this week. One, we've owned Costco for a long time, and we had grown into a pretty significant position in the portfolio. So we trimmed that back a little bit. Part of that has been on the underperformance of staples as of late because of this news on Ozempic, which, we're having a bit of an AI moment with these weight loss drugs. It's like, oh my gosh, everybody's going to take these weight loss drugs and everybody's going to lose weight. Nobody's going to eat junk food anymore, and everybody's going to get new clothes. So we've seen a bit of a contraction in staple stocks. That's pretty much that's going to be a fairly false analysis going forward. These drugs do make you want to eat less, but it doesn't make you want to eat better. So you don't stop eating junk food. You just go to McDonald's, you order your quarter pounder with cheese or whatever, And instead of eating the whole thing and a complete order of fries, you eat 3 bites and you're full and you don't want it anymore. So, but you're still spending the same amount of money on junk food. So, the narrative will work itself out over time. Plus, there's some really bad side effects from these drugs that will have to be worked out over time. And again, if you're not prescribed a drug, it's $1,000 out of pocket. And there's not a lot of people that are going to do that. So this kind of narrative that everybody's going to get on the drug is probably not valid. But so again, we did trim back our staples just a little bit. We were overweight staples in our portfolio anyway. Trim that back, and then we had sold ExxonMobil a couple of months ago. That didn't sell at all. We just had taken some profits out of it because
you did your gardening that you talk about. Yeah,
we did our gardening, and so whatever Tuesday or Wednesday of this week, we took that into an overweight position after the day they actually announced their acquisition of Pioneer Resources. The stock took about a 5% hit, and we overweighted our position in ExxonMobil because we like the company long term, and the acquisition of the Shell driller really expands their whole kind of base production model. So it looks really good going forward.
Okay, and just FYI, folks, again to mention the conference, Rick Rule just recorded his presentation as he did last time. He just leaves it all on the playing field, just shares dozens of companies and tickers of the companies that are on his personal watch list or in his personal portfolio. He gave a bunch in energy, and he gave a bunch of names that probably most people, we don't hear every day. But he did say that ExxonMobil was at the top of his list for those that want to, invest in quality. And he said that they are probably the only oil major that is investing in CapEx enough to maintain their current levels of production. So just FYI, if there's sort of a gold standard in the space, I think Rick would say it's definitely Exxon. So if you think it's a good time to buy them, Lance, it's probably saying something.
Yeah.
Okay. Because you brought up Ozempic, I just got to ask you this. So you and I, we're big health and fitness guys, right? I'm just curious. What do you think about this Ozempic trend? Part of me wants to resist it a bit. Like, it's the easy button, and the easy button is never really it addresses the symptoms, but it's not really curative, right? Is this mostly that, or at the same time, like, are we just happy that it's better than not doing it, right? Is it better to be morbidly obese and not take it, or is it better to lose the weight and get some of the health benefits from being, less overweight? But you're not necessarily, it comes with side effects, and that, again, it's maybe not necessarily still curing you of the core unhealthiness of your lifestyle. What do you think?
So, I have personal experience with this. So my wife is going through menopause, and hopefully she will never see this video that I'm making with you right now.
Kill you for sharing all this personal detail. Yeah,
this will be my last video if she finds out. But look, my wife's in her late 40s. She's beautiful. But when you go through menopause, your body changes a lot, and losing weight and trying to keep weight off becomes very difficult.
A lot harder
at that age, and especially when you're going through that hormonal change within females. Guys go through it too. We have a big drop in testosterone, and that's why you see all these centers out now. Come in and get your testosterone shot, right? Boost your testosterone, lose weight. So, but as men age as well, our hormones and our testosterone fall, and it becomes very difficult for us to lose weight as well. So this Ozempic and the related drugs all work off what's called the semaglutide, which is basically this chemical that makes you not want to eat effectively, and so it's almost like a forced diet, to for lack of a better term. And so part of my wife's regimen, so she's going through hormone balancing right now, and we work with a very specialized doctor, both I and her, to balance our hormones and get us, keep our health standards as high as possible. Of course, having said that, as you know, and as we talked about here on the show, we combine that hormone balancing. That's just not all we do. We eat very, very healthy. We exercise every day. So we have a very a very rigid program that both she and I are on. But I can tell you that this semaglutide issue, and no matter what kind of version you go, it just makes you not want to eat. In fact, the sound of food in a lot of cases just makes you kind of ill. It's like, I just, she goes through this. She's like, I would love to eat, but when I look at food, I'm just like, I don't want it. And so that restriction and that caloric intake, you're starving yourself, for lack of a better term, and it forces your body to start consuming itself. And so the issue that you have from a health factor is that, yes, you're going to lose weight, but you're not going to be healthy. Yes, if you're diabetic, you're going to lose weight, and that may help with the diabetic syndrome, but it doesn't force you to eat a healthier diet. It doesn't force you to go out and start exercising and doing all the other things that are necessary to be healthy and to conquer that disease long term. And you can't take this drug for the rest of your life. You can only do it for a very set period of time, and then you've got to come off of it because it's not good for you. The side effects are not great. So, everybody's jumping on this kind of weight loss miracle as the new AI trend for stocks. And, it's going to have an impact, I will tell you. And these drug companies are going to make a crap ton of money off of this. And they're going to be sued down the road out the wazoo because of all the side effects. But the drug companies don't care about this. They're going to make billions of dollars, and they'll settle this thing for a couple of billion down the road. And it'll be fine. They'll be very profitable from this. But this isn't the cure-all. This is the easy pill to try to lose weight. But we were having this conversation this morning. I have friends of mine that are very overweight, and they're perfectly happy being overweight. They like going out and drinking what they drink and eating what they eat, and they don't care that they're overweight. I mean, they're very happy and content. They're not going to get on these drugs ever. Right? Until somebody forces them to. So, I'm not sure this turns out to be the massive gold rush that people are building into companies right now that are producing these drugs. It is going to be beneficial. They are going to make money off this. But, I think this runs its course kind of fairly quickly over the next 2 or 3 years.
All right. I actually got a ton of questions. I'd love to keep talking with you about this, but we are super tight on time. Yep. So we're going to have to pick them up next time. Lance, I know you got to hop because you've got a video, another interview to do, I think now. So yeah. I'll say goodbye to you, and then I'll just I'll walk folks out here. Thanks so much, so Lance. It's been a great week.
See you next week.
All right, folks. Just details on the conference real quick. If you haven't registered for it yet, if you're watching this weekend, it's time to lock things in. We still have the last chance to save discount price up until midnight on Sunday. So if you're able to do so, head over to wealthion.com/conference. You'll find all the details of the conference there, and you'll be able to lock in that last chance to save discount before it rises to the full price on Monday morning. And if you're watching this video after that, well, you still have up until the morning of October 21st, which is a Saturday, to buy your ticket, because on that Saturday, we're then doing the conference. If you can't watch the conference live, don't worry. Everybody who watches is going to be sent a replay video of the entire event, all the presentations, all the Q&A. So it's everybody's going to get a chance to be able to watch everything within 24 hours of the event ending, hopefully even sooner. And as we do every week on this channel, I think Lance made a couple of great points on it this week, especially if you're interested in buying bonds, like individual bonds. Highly recommend that you work in trying to figure out how to guide your capital through what's coming. Work under the guidance of a good professional financial advisor who understands all the macro issues that Lance and I talked about and takes them into account in their portfolio allocations. If you've got a good one who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, perhaps even Lance and his team there at RIA, then fill out the short form at wealthion.com to schedule a free consultation with one of the financial advisors that Wealthion endorses. These consultations are totally free. There's no commitment to work with these guys. It's just a free public service that these financial advisors offer to help as many people as possible, position as prudently as possible for what's most likely to happen ahead. Thanks so much for hanging with me, everybody. If you enjoy these weekly market recaps with Lance, want to see them continue into the future, please vote your support for that by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. Thanks so much for watching, everybody. We'll see you next week. you.